Going?
We going.
It's Fed Friday, everyone. Welcome, welcome, welcome. I'm
Welcome.
Darlene,
And I'm Rita Bailey Rowland.
and this is Fed Friday. So we're going to go ahead and get started. Before we do, Rita, you want to say something to everyone out there?
I just want to say that this month we're going to really talk about life insurance. And we're going to turn down that music a little bit so you guys can hear us. We're going to talk about life insurance this month. And this is very personal for me because as many of you have come to my workshop, you may know that my mother died when I was 11 and she was 34 years old. She worked for the post office. And so understanding what you have, make sure you have the right insurance in place, make sure you have enough that if you have young kids, how much money do you need to last until they finish college and pay off the house? And because we didn't have enough, our lives totally changed, which is why I got into this industry. So what Darlene is going to share with you today is really personal, that you understand it and then you let us help you put the right plan in place. Because I'm not saying that all term and this is the best thing to have, but it's important that you understand. So what we do here at ABS, we want to bring you understanding, knowledge, and then we can help you make some very wise decisions. So I'm gonna hand it off to Darlene. I'm going on mute. I'm here to answer any questions as she go along. Hi, Robert Bailey. That's my brother, y'all. And hi, Miss Delia. No, Delia.
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 Delia. Hey,
Delia
Delia.
Lopez. I'm gonna get that Miss Lopez. Let me just say that. Good morning, everybody, and welcome. And good morning, Facebook. We appreciate you. And I'm gonna turn it over to Miss Darlene. I'm going on mute.
Okay, well, I had to take myself off mute. So I have up on the screen what's going on here. Our Fed Friday event is every Friday morning at 10 a.m. We broadcast simultaneously on Facebook. And we're now this month rather, we're diving into life insurance. Please remember when you get on, I know you want more, but this is just 15 to 20 minutes because we know a lot of you are at work and we don't want to interrupt your workflow too much. So if we go over something and you want more, give me more, then contact us, please. Our information is going to come up at the bottom. Please make sure you tell your friends to go register at www.ritabrolandevents.com so that they can get all of the information, all of the reminders rather for the webinar, because a lot of you can't get on Facebook at work. If you missed the broadcast, you can always go to Facebook and check it out. So what we're doing, like I said, is just going in depth on understanding all of the benefits you have as we're trying to help you prepare to reach your financial destiny. And that's what this Fed Friday series is about. Please, this is going to be very general in nature. Everyone out there has a different situation. The only way we can help you with your particular situation is if we know what it is. So please take the information that we have, see how it can apply to you. If you have questions, please, again, contact us. You need to reach out to us. We will offer you a complimentary financial benefits analysis going over what you have and how we can help you. So thank you for understanding that. So as I said, we're doing life insurance. So before I get started because this is for the feds this week, so we're going to be going over their benefits. But what I like to do, Rita and I, is just explain to you the difference between term insurance and permanent insurance. That is one of the biggest questions we get. And the other question we get is, well, which one is better? Which is better? It depends on your situation. They're both good. Neither is nothing wrong with either one. So with this illustration, you will always be able to keep the difference straight in your mind in terms of what you want. So when you look at term insurance versus permanent insurance, compare term insurance to renting an apartment. Permanent insurance is like owning or buying your own home. What do we mean? When you have term insurance, okay, it's like renting an apartment, because when you move into an apartment, it's very low cost. Normally, all you need is your first month's rent for a deposit. Now, if your credit is a little shaky, they may want too much. But the cost is very low in the beginning, because when you move out of your mama's house or your daddy's house, you're just trying to get out like, I need my own space, period. So the cost is very low to get in there initially. But What happens on the next year on your anniversary of the day and month you moved into that apartment? Your landlord sends you a love note saying, we're so happy that you're still with us. However, your rent just went up $40, $50. The same thing with term insurance. At the end of your term, that cost is going up. Now, also, when you're living in an apartment and you're ready to get out because you're tired of paying rent to the landlord, when you get ready, when you turn in your 30-day notice, do they give you a love note saying, oh, you know what? We've been saving part of your rent to go towards your new home buying program. No, they don't. So just like when you live in an apartment, you don't get any money back. When you have term insurance, you also don't get any money back. As it says here on the screen, is no equity or cash buildup. Also, the coverage ends with term insurance. The coverage is going to end at 10 years, 20 years, 30 years, whatever the term limit is. Just like when you're living in an apartment. You're like, look, I'm not going to keep paying this rent, so I'm leaving. Same thing with the term. Like I said, it's over at 10, 20, or 30 years. And normally people buy term is purchased to meet a temporary need. Like when you get mortgage protection. And if you need mortgage protection, call us. That's only 30-year term insurance or 20-year term insurance. Anyway, so it's purchased to meet a temporary need, like paying off your mortgage or your children are young. Now, when you have permanent insurance, the reason we compare this to owning a home is because when you move into your home, when you're buying a home, you can't put down your first month's mortgage payment. No, you have to put down 5, 10, now they want 20% of the cost of your home. So it's higher to get into your home initially like it is with permanent insurance. But once you're in your home, just like when you have a permanent policy, your premiums are level. If you buy a 30-year fixed mortgage, your mortgage is going to be fixed. It's going to be level. So when you have a permanent policy, your premiums are level. Also, just like your home builds equity, when you have a permanent policy, your policy builds equity. It has cash accumulation and the coverage never ends. Well, the coverage does end when you cross the river, meaning when you pass away. Now the coverage is over. But as long as you're alive, your coverage is alive. And people generally get the permanent insurance to meet a permanent goal, like using it for retirement. We'll get into that in a couple of weeks. So also, you know, for kids, college, but it has a permanent goal. So now, at this point, everyone should know the difference between term and perm. Do you want to rent an apartment or do you want to own a home? That's the difference. So now we're going to get into the Federal Employees Group Life Insurance Program because a lot of you out there are federal employees. So with the group life insurance through the government is ran by MetLife, okay? Your coverage options that you have, in addition to your basic, you have option A. Option A is a standard $10,000 in life insurance coverage. However, you also get an additional $10,000 in accidental death benefit coverage. You're not paying for it, it's free. You also get option B. This is where you can get anywhere from 1 to 5 times your salary in coverage. And I have to say, with this option B, most employees end up spending anywhere from $20,000 to $30,000 and sometimes more, depending on how much they're earning, over their working career in this option right here, option B. And as we get through, I'm going to show you what I mean by that. You also have option C. If you have families, you can get your family members covered. You can also, under option C, choose anywhere from 1 to 5 times your coverage. Now, under the option C, your spouse is covered for $5,000 rather, and your children under the age of 22, unless they're special needs, they're covered for $2,500. So if you get the 5 times option under the family option, then your spouse has $25,000 worth of coverage, and your children are covered for $12,500. Okay? Now, I don't know what's going on. So, on your pay stub, those of you who work for the government, Now, a lot of you may not work for the government, but you still have, just because we're going over the government, please, if you're in private industry, don't tune this out, because normally in private industry as well, when you have, this is group life insurance. So when you leave the group, generally these same rules are going to apply to you. Now, because every company is different, we don't know about the pay increases in the group life insurance. But overall, it's group life insurance, and it's going to work the same for you as well. So in the government, when you look at your pay stub, on line 81, that's where you'll see your basic insurance coverage. So the way it works, this is how, because when we talk to federal employees, you're like, how much insurance you have? 10,000. I think I have 50,000. This is how you'll always be able to know exactly how much coverage you have. You take your pay, you take your annual income, and it's right here on the screen. Take how much you earn a year right now. You round it up to the next highest thousand. So if you're earning 84,372, then you round that up to 85,000. And then to that number, you're going to add $2,000. So your basic coverage is $87,000. That's how much you have in group life insurance. And then to that number, to see how much you're paying for it, you multiply it by 15 cents per thousand. So 87 times 15 cents. This person is paying $13.05 a pay period for it. Now, let's look at your option A. Every option you pick costs money, additional money, depending on what age band you're in. The group life insurance is age banded in 5-year increments. So when you're young, you're really not paying any attention to the cost of that coverage. I'm sorry, Rita, what'd you say? 18 to 30, Rita wanted me to tell you, because I neglected to say this, but 18 to 35, everyone is paying the same rate. It's not until you get to age 36 that now the age bands start kicking in. But we're starting at 45 because this is where the money really starts getting more expensive. And as you can see here under option A, remember, this is just your $10,000 in coverage that you had. So as you can see, when you're 45 to 49, it's only 90 cents per thousand. And these cents, it doesn't sound like 90 cents. Oh, what's that? That's nothing. Even, but you look down here for option A, when you're 60 to 64, that's $6 per thousand. Wait a minute. Let's get to option B, because that's where a lot of you have your coverage. When we talk to you like, oh, well, I have coverage through my job, which is great. However, let's take a look at that. So you have option B. Most people have 5 times this, anywhere from 1 to 5 times. We're doing an example of 5 times. And this person is, their income is $85,000, like we had in the prior slide. So when you're 45 to 49 for your option B coverage, you have $425,000 in coverage. Look, it's only costing you 8 cents a thousand. That's nothing. You're not even sweating that. $34 a pay period. You're used to that. But you turn 50, you know, we all celebrating. We 50. I know I was excited when I turned 50. Now you're paying 13 cents. Okay, another 5 cents. That's nothing. But it's $55.25 a pay period now that you're paying. So that's an additional $13 that's coming out your pay. But in this area, we high rollers, right, y'all? Ain't nobody missing no $13. We eat that one day at lunch. So we're not even missing it. But look down here when you have your 60th birthday and you in the government, civil service and FERS employees, because a lot of you all are going to be around. Invite me to your birthday party. And then I'm going to be there the next day when you get the next time you get your pay stub and you see this big hike. Because when you're 60, to keep that same coverage, you're now paying 52 cents a pay period. That's, now 52 cents, darling, that ain't no money. But that's $221 a pay period. You get that pay stub and you see you missing over $100, $150. You're about to be making some phone calls to HR, something going on. Only thing that went on is that you had a birthday. And every 5th year birthday that you have, the cost is going to continue to go up. Now, in our other series, and I'm going to get to it when you retire, but look at that. When you're 65, Now you're paying another 40 some dollars a pay period for that $263 a pay period. And this is someone who's earning $85,000 a pay period. If you're earning $100,000, I know some of y'all online right now logging into MyPay or EPP or Employee Express, pulling up your pay stub, and you need to. You need to be aware of what's on your pay stub. Ever since when I was in the government years ago, in a land far, far away, when they used to mail us our pay stubs, we looked at that pay stub because we wanted to know what was going on. But now, since it's online and we have direct deposit, all we want to do is make sure that the money that's supposed to go into the account is going into the account. But you have to look at your pay stub to see what these benefits are actually costing you, okay? Now, option C, this is the family option. Like I said, this option is age banded also, and it continues to go up in the age band as everything else. So as I said, the spouse is covered for $25,000 and the children are covered for $12,500. But keep in mind, this is not like the Affordable Care Act. These children your children drop off at age 22 unless they're special needs, and then they can stay on there, for the duration. But at 22, they're off. Unlike Affordable Care Act, they're on to 26. So please keep that in mind. Now, what happens to your basic insurance when you retire? Okay, you have three options. Now, the first option is that you don't have to have any reduction at all to the insurance. You can keep it at full force, in full force rather. However, before age 65, it's going to cost you $192.52 a month. After 65, it's basically costing you $165 a month. Oh, let me use my mouse if I can find it. There we go. It's costing you $164.90 after retirement. Now, if you've been following us from the beginning, first employees, if you retired with this high three average of $80,000 a year, then your check per month is only $2,000 gross. That's very gross for some, I know, but that's gross. And now this is coming out. So, and before any taxes or your health insurance, or you can choose a 50% reduction, meaning I don't want to keep the whole 85, I only want to keep 50% of it. So for that option, you're going to have $42,500 in coverage, and it's going to cost you $82 a pay period. But this option right here, the 75% reduction, this is what most employees choose. Why? Because after 65, this is what they pay. But you only have now 25% of the coverage. And when you're looking at it, you're like, oh, well, I know I'm just going to keep it at the full amount, no reduction. But when you look at your expenses, your budget, how much you're going to have coming in from your three streams of income, that's why most people choose this right here, the 75% option, where they're not paying for that. Or when you go to process out, you have to make sure you're fully aware of what's going on. That's why you need to contact us so we can help you get through this transition period when you're about to retire, and even right now, so we can help you with making sure you have the right amount of coverage in place. Now, option B, those of you that are doing option B, what's going to happen to your insurance after 65 and when you're in retirement? Y'all ready for this? You're 65 to 69? Well, we're just going to go what's happening right now after 2016, because FEGLI changed the laws. As you can see, it was more expensive, $570, and now it's $497. Still, you got a $70 break, but it's still $597. And every 5 years that you keep this in retirement, it's still going up. When you are 75, it's now costing you $1,657 a month. For some of you out there, you're going to be sending the government a check to keep your coverage in force. That's why it's important to get something in place now. This is the youngest you're ever going to be right now. So this is why you want to look at, what am I doing with my group life insurance? And is this the time for me to get some supplemental insurance? Because realistically, am I going to be able to afford to pay this out of my pay? Rita?
Yes, and what I wanted to say was one of the things why I put this slide in to show you the price, and people say, Rita, well, it's really past the 15. The government realized that many people were going outside to get their insurance. So what they did was they lowered the rate, but they lowered the rate while you're working. But what most people don't realize, when you really need it the most, because at this stage, when you hit 75, you're in the third quarter of your life, people will probably be passing away somewhere. That's where the cost is astronomical, because who can afford, even if you're making 100 grand under the old system, you can't afford to give a third of your retirement or 40% of it to some term life insurance. So you end up paying $20,000 to $30,000, some more, 40 to 50. If you get to this age, you're giving them probably over 5-6 figures in terms of premium for life. That's $2,400 a month. So for a year, we're talking about $30,000. So it's very important to understand it long term. Again, Darlene said, don't go to your pay stub online and cancel anything. Make sure you sit down with us. We can help you come up with a strategy that best suits you, your family, and your needs, not now, but long term. Back to you.
Absolutely. Please don't cancel anything, because there's a lot of factors that go into determining what you should keep and what you shouldn't. So as Rita said, with your health, your age. So please contact us first before you do anything. So questions you should be asking yourself concerning your life insurance. What are your life insurance needs? Life insurance is so much more than when our grandparents used to get it. It's not just for burial anymore. How much do you need? Who's going to suffer or have lack when you're gone? Right now, most people just immediately think about, oh, my children are grown, I don't need it anymore. Not our dependents aren't just our children anymore. It may be our mothers, our parents, like my mom, your parents, your siblings' children, your grandchildren. And if you're gone and you're providing for them, who's now going to take care of them? Also, your estate preservation. Yes, you have an estate. You may not think you have much, but you do. You have more than you realize. So how much of your assets do you want to protect? If you're leaving a tax-deferred account to your loved ones, you know, like your TSP, your 401ks, your mutual funds, IRAs, you have a home, a timeshare. Now, unless these Republicans are successful in rolling back the estate tax and getting rid of it permanently, you are going to have some level of estate tax that's due. Where are they going to get the money to pay for those taxes? That's where life insurance comes into play. Also, how much liquidity, what are going to be your liquidity needs? You have your burial expenses, housing, your children's education. If something happens to me right now, I want to make sure that my daughter can still go to the school she wants to go to, although her godmother, Rita, is going to be there for her. Rita's like, look, you're not going off to this school because your mama ain't leave you enough money. That's why I want to make sure Rita wouldn't do that. But she may be in a position where she can't. The person that your child would be left in their care, they just may not be able to do the things we as parents would sacrifice and do. Your parents care. If something happens to me right now, I contribute significantly to my mother's caregiving needs right now financially. So if something happens to me, what's going to happen? If something happens to you, how are your parents, if you're helping them, where are they going to get that money from? And if you leave them the beneficiary, this is why you need to talk to us. If you have a special needs child, or you have a parent that's getting some sort of government or state assistance, you cannot leave them as the beneficiary. Why is that, Darlene? I want to make sure they're taken care of. You still can. That's why it's important to talk to us. But if you leave that money directly to them, guess what you just did? Cut off all of their federal or state assistance. Why? It's needs-based, and they no longer have a need because you just left them $50,000, $100,000. Also, later in life, your retirement income, you can leverage your permanent policies to get a lifetime income off. Housing, your spouse's caregiving. Some of you out there, well, I'm dead. He's going to be all right. But if he died first, ladies, don't you want him to take care of you? You should be thinking the same way about him, because when you walk down that aisle, or the person you're living with, your partner, whether you're married or not, you made a commitment to that person. And when you're gone, those bills are still going to be coming in. And if you have children together, those children are still have goals and things that we want to get taken care of. And as I said, we would examine, do you need term insurance or permanent insurance? So those are questions that we can help you answer. Make sure you reach out to us. And everyone, that concludes our presentation for today. Next week, we're going to be getting more into the different types of insurance that fall under the permanent. We're going to bring on a special guest, one of our other team members, Ms. Javon Walker, who's going to be going over the concept of you be the bank. Aren't you tired of getting loans from Bank of America and Wells Fargo? You can become your own bank.
How about some of us can't get a loan from Wells Fargo? So how about we create a system where we become our own bank, and it's not based on your credit. It's based on how you create your wealth, and that's what we'll teach you.
Exactly. No more loan denials, everyone. So thank you all for coming on. If you have a question, we're going to stick around here on the live webinar. Facebook friends and family, if you have a question, please inbox us. We'll happily do it, and share us. Don't keep us a secret.
No.
Share us with your friends and family. Share it on your timeline. Thank you. Last week, 2 people shared our timeline. So, and I don't even know if I'm saying that right, but you shared our information. I'm still learning. Where's that Facebook for Dummies? So I need it. But thank you all so much. So until next week, we'll see you back here on the broadcast. Yes. Thank you so much.
It's Fed Friday. Have a great weekend. No questions?
One person.
Good question.
Tawana just said.
Yeah. Okay, you guys are all clear. If you don't have any questions, feel free to contact